Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And today, it occurred to me. A little question as I was preparing for the webcast today occurred to me. It's going to sound a little bit goofy, but I thought if buy low and sell high sounds so good, why does it feel so wrong when we attempt to do it at times? Today, we're going to be talking about rebalancing in an investing portfolio and why that can just feel unnatural. It can feel like we're doing the wrong thing. I want to have this discussion. I think it's going to be an important one. We have some good examples in our example paper money portfolio to use in that discussion. So let's dive into that. But as we do, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names out there in YouTube. It's hello to everybody that might be here for the first time. But hello there, Lawrence and Jay Richardson, Robert, Cynthia, Eva, Sam, Rojo, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, as I mentioned, I do want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream audience. If you'd like to be here in that audience, this is a Thursday webcast series, and we kick things off promptly at noon Eastern Time. Now, I also want to let my live stream audience members know that my very good friend Brent Moores is hanging out in the chats with us today. Brent and I have now been working together, or I think this is our 22nd year together on the same team. So Brent brings a ton of experience to this discussion. He's going to keep an eye on the chats. If any questions come in that I can't get to, Brent's going to be there to pick up my slack. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening, whether live or on the archive, to follow your favorite Schwab presenters on social media. You can follow us on X. You can follow us on LinkedIn. For Brent, his X handle is at Brent Moores CS. You can find me on X at Cameron May CS, or you can jump over to linkedin.com/in/Cameron May CS again, and that'll take you to my profile on that platform. Give me a follow there. But let's get into this discussion. And today is going to be about this process known as rebalancing. And if you understand what that is, that means that we're going to be directly trying to implement this concept of buy low, sell high. And I think it's going to challenge some of us. I think it's going to feel like we're doing the wrong thing. So I want you to be honest with yourselves as we go through this. As we do go through it, of course, we also need to bear in mind the risks associated with trading and investing. Keep these disclosures top of mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's lay out the agenda for what we're going to be covering today. I do want to see what's going on with the markets, and in particular, what's going on with income-oriented markets. That's what this webcast series is all about. So we're going to look at a couple of different indexes that might allow us to keep our fingers on the pulse of what's happening in the income investing market. Then we're going to switch over to our example paper money portfolio, look at our existing positions. We are fully invested. Don't worry, that doesn't mean we're not going to do more investing in future weeks, but there's been a development with a couple of those investments that I think is going to give us the opportunity to demonstrate this concept known as rebalancing. So first thing we'll do is just go through the portfolio, do our typical checkup, but then we're going to talk through the process of rebalancing, which is just repositioning positions within the portfolio for very specific purposes for ultimately, hopefully, to reduce risk and to help the investor sleep a little bit better at night while they're waiting for their dividends to be paid. Now, I do want to, as I mentioned, I want to give the heads up that this is going to feel unnatural to some. The specific adjustments that we make are going to be counterintuitive in a lot of ways. So keep your eye out for that. Be honest with yourself about whether this is striking you as the right thing or the wrong thing. I'm going to get your input on that. Eva says rebalancing often occurs at or near year end generally, right? Eva, so it's entirely up to the investor. The investor is with that longer term horizon. Very commonly, we'll have kind of longer term time frames for when to rebalance, maybe 6 months, maybe every year. Or there might be specific things that trigger a rebalance at just random times through the year. All right. But let's get into this. Let's go right to our example paper money portfolio. Here are those 20 positions, and we are fully invested. We started off with $200,000 in an example portfolio. We've been dedicating 5% across 20 different stocks for each one of these positions. So we've kind of run out of money. So what we're going to do next week is open a new account. We're going to fund it with an additional $200,000. We're going to be managing a couple of portfolios. I'm not going to just randomly sell stuff just to create portfolio space so that we can continue investing. Let's not do that. What we'll do is maybe next week we'll pretend we got a windfall and just continue building a second portfolio. But for right now, let's go see what's going on with the income-oriented markets. Starting with the fixed income market. So what we're looking at here is TNX:CGI. It's basically a chart of what's happening with 10-year yields on long-term government securities. And right now the average yield is sitting around 4.64%. That's how we would read that number. And those yields have been on the rise. Now for dividend stocks, this is not necessarily the best news because there can be a competition going on for the cash that can be allocated to income strategies. So let's say that we have two investors and they're both eyeballing the income market. And if they see maybe one has their eye on stocks, the other one has their eye on fixed income. And boy, the fixed income continues to pay higher and higher and higher yields or interest. That could even attract the attention of the other investor, and all the money starts going toward fixed income. It can draw it away from stocks and put downward pressure on prices for those that remain in, let's say, income-oriented equities or stocks. So we like to keep our eye on what we call the competition. So that's what the 10-year yield represents. And as yields go up, maybe this becomes more attractive and can draw money away from stocks and put those pressures on stocks. But yields really have continued to rise. They're off a little bit today. Notice we've sagged back, but still overall from the end of February, 10-year yields were down below 4%, and now we've reached up closer to 5%. Haven't gotten there, but up to about 4 3/4 before this recent little pullback. This may have slowed the capital appreciation of a lot of dividend stocks. However, it hasn't stopped it. Dividend stocks have actually still, in the face of this pressure, had a pretty good year, even at a lot of times outperforming non-dividend paying securities as a whole. All right. So if we look forward to the rest of the year, what may be going on with yields? We don't know exactly on the 10-year yields. Don't know exactly, but it seems to be more and more likely not for a Fed rate cut, but possibly a Fed rate increase. And this marketplace may be pricing that in already, those assumptions. Time will tell. We'll see what the Fed decides to do. But let's go see the net impact on our dividend stocks. Now, I'm going to be using kind of this awkward long symbol here. I pronounce it phonetically. I'll just refer to it as SVIDMUT. Helps me remember what it is. But specifically, so it's $SPHY-DMUT if you're following along at home. But this is the S&P 500 Dividend Monarchs Index, and it's a total return index. So the dividend monarchs are companies that have been increasing dividends, paying and increasing dividends every year for the last 50 years. All right. And this chart reflects the performance of price on those stocks, but it also adds in the dividends that have been paid. So we're seeing a total return for the last 12 months. And you can see if we just focus right on, let's say, the 1st of January, 10-year yields have been generally going up, we saw since February, but actually dividend stocks have still been having a really solid run, at least as represented by this group of stocks. And that even persists right up to today, up another 0.25%. So our portfolio has largely participated in this. Now, we weren't fully invested back in January. We made our first investment on January 8th. But overall, our portfolio has done pretty well. We've been layering in one at a time. We've picked up 20 stocks over the course of the last 8 months, 7.5 months. But if I go to our monitor tab, let's go check on the progress of those stocks. So here are our 20 stocks. These are allocated across all 11 sectors in the S&P 500. We have 9 sectors where we own 2 stocks in each sector, and we have 2 sectors where we own 1 stock in each sector. So that brings us up to our total of 20 stocks. So diversification has been emphasized in this webcast series. There are arguments for diversification, there are arguments against diversification. What an investor is typically attempting to do by diversifying, they're trying to lower the overall volatility of their portfolio. And maybe, theoretically, if one sector is falling a little bit out of favor, maybe some other sectors that perform better under the same economic environment conditions, maybe that'll pick up the slack a little bit and lower the overall portfolio volatility. And we've seen that to a good extent this year. It's not always the case. Diversification is not a guarantee against risk. It's not. But we have our 11 different sectors represented. In those stocks, we have been emphasizing yield, the dividends that are being paid. That's what this webcast series is all about. An average dividend paying company in the S&P 500 is paying just a shade over 1%. Our average yield, let's see, I ran that number this morning. I think it was about 3.2%. I want to double check my notes here. Yeah, 3.19%. George says a good benchmark to see how your picks are doing. Oh, I can't mention that, George. My apologies. Can't talk about ETFs in this webcast series. So maybe a good observation there. I just, can't bring that up. In any case, yield on our stocks is roughly 3 times average, not quite, but pretty close. Another point of emphasis for this webcast series is the volatility of those stocks. If you're not familiar with beta, a beta score is a gauge of how volatile a stock is versus the S&P 500. A beta score of 1 means that our stock typically just moves about the same amount as the S&P 500 and in the same direction. A beta score of less than 1 means that our stock is typically less volatile, doesn't move up as fast, it doesn't move down as fast as the S&P 500. A beta score over 1, like our TXN, down here it has a 1.32, this would imply that it's about 32% more volatile than the S&P. Now that might sound inherently bad, it's not. Volatility can work for the investor, it can work against the investor. For example, if the S&P is going up, maybe our stock can go up faster. Unfortunately, on the flip side, a stock that has a stronger beta will tend to move down faster than the S&P as well. Mark says, do some investors have a sector rotation strategy when managing their dividend investments? Just wondering if this is common. Well, Mark, I certainly understand the concept. I can't speak for every investor. I can say almost certainly, yes, there are going to be some investors who will keep an eye on what we call sector rotation. That is a typical economic cycle might last anywhere from peak to peak, trough to trough, maybe 4 to 6 or 7 or 8 years, where the economy sort of ebbs and flows. And under different economic conditions, there theoretically are some sectors that may perform better than others. So if an investor feels like they're pretty dialed in to where the economy is, maybe it's in a strong growth phase, and there might be sectors such as technology that tend to perform best early and into the middle of a strong growth phase of the economy. Maybe they overweight toward technology. Or if the economy is in late expansion, early contraction, things are looking a little bit skittish, maybe there's a retreat to quote unquote safety. I always have to put that in air quotes because if the markets are pulling back, no guarantee of safety anywhere in the marketplace. Anyway, but traditional economic models might say that there are certain sectors that may outperform others, even if they're just falling less rapidly. When the economy is in contraction, and maybe those sectors might be the things that we need, whether the economy is strong or not. That might be energy, it might be utilities, staples, healthcare, those kinds of things. And so they may reallocate that way. I'm not doing that in this webcast series. We will talk about those models from time to time, just so that we can address that, because it can be an important concept for some, but I'm not going to go so far as to try to implement that into this example portfolio. All right, so that's a good question. But beta is emphasized, just overall volatility. I think we only have 2 stocks, that are above average in historical volatility. The rest are below. So the net there is our average beta is about 0.73. In other words, as the S&P goes up, we might expect our portfolio to sort of trail along only about 73% as rapidly. If the S&P drops, maybe we pull back roughly 73% as rapidly as the S&P does more broadly. Certainly not a guarantee, but that's just a gauge of, is the investor walking themselves into sort of a more volatile portfolio structure, or has it been structured to be less volatile? Now, let's move over here, have a look at the fun stuff. Profits or losses. How's the portfolio doing? We're up 11%, about 11.1% overall for, well, just since each of these positions were initiated. Some of these were purchased back in January. Some were purchased within the last couple of weeks. So to be up 11% when maybe on average we've been in a position for 4 or 5 months, that's pretty strong performance. Plus we might layer in about maybe 1.5% that's been collected in dividends for the year so far. Something like that. Yep, probably between 1.25%, 1.5% that's been collected in dividends. So overall, if we're talking about the total return, unrealized gains on the stock plus dividends paid, we're probably around 12.5% year to date. All right, that's totally fine. It could have certainly gone differently. But this growth brings me to the topic that I wanted to discuss today. And that is, there's something happening behind the scenes, even in a well-diversified portfolio, where risk is shifting. And it can happen at times when everything seems to be going optimally well. There's a phrase that we use in sort of diversification circles that describes this process. It's called risk creep. And here's our example of that right now, Target. Look at our Target position. This is a stock that we purchased. This is our very first investment in this webcast series. If I click on the quantity here, we bought 100 shares. If I click on that quantity, you can see this was purchased January 8th, very first position in this example portfolio. I just started this series in January. And we invested $10,000 of a $200,000 portfolio back in January because that was 5%. Well, our portfolio has grown. We've made in unrealized gains about $22,000. So our portfolio started at $200,000. It's now at $222,000 and change. But Target, which is supposed to be 5% of the portfolio, is now 7%. We need to do some math on this. All right. Let me do some quick math. It's pretty straightforward with Target. If we own 100 shares, and those shares are right now worth, you'll notice there's a column here that says mark. That's the current market price of Target. You might think of it that way. It's $154.83 stock. Let's call it $155 just to round off some pennies here. That means if it's $155 per share, on 100 shares, that's $15,500 that we now have invested in Target thanks to the appreciation of the stock. If you want to see this on a chart, let's bring up a chart here. So right back here is where we bought those shares. And you see, this has been a great year for Target. So has it been a good investment? Yes, it's been a good investment to this point. But here's the potential problem for a long-term investor who's trying to keep their portfolio in balance. And that is, we just discussed, our shares are now worth $15,500 on a portfolio that's worth $222,000. So this is now 7% of the portfolio. Now that doesn't sound like a lot. Let's outline this. So Target is now 7% of our $222,000 portfolio. Okay, it was 5%. Now it's 7%. That's only 2%. That sounds like nothing. Well, another way to put that is this is now, if our average position is 5% of our portfolio, 7% is actually 40% larger than the average position. That's a big deal, right? We have a stock that is much larger in size than other positions within the portfolio. And as a matter of fact, we have another stock. Let's go back here and have a look at our worst performing stock. What's our worst performing stock? We have NEE. When did we buy? That was purchased in February. This one's kind of struggled along. So NEE, we bought 107 shares. Let's do some math here. This one's going to require the calculator. We bought 107 shares. Those shares are only now worth about $41, $40.98. No, let's see. No, there it is. $85.91. So let's multiply this by, let's try that again. 107 times 85.91. So these shares are only worth about $9,200. So we have one stock where we have a $15,500 position. We have another stock where we only have a $9,200 position. That's 68%. Let me do the math on that. 15,500. That's how much we have in Target, minus $9,200 in NEE. That's a $6,300 difference. And if you compare that to the value of the NEE shares, 68% more money in Target than we have in NEE. So what does that cause an investor to do? Kevin's saying, hey, it looks like a great place to take some profits on Target. Kevin, spoiler alert, it's exactly what we're going to be doing today. As counterintuitive as that sounds, we are going to be selling some Target and using that money to buy some NEE and a couple of other stocks. But I think to some, you're going to say, wait, Cameron, hold up. Here's Target. This is literally our best stock. I love this stock. Investors can fall in love with positions that have treated them well, and the ones that aren't treating them so well, like NEE, we purchased these shares, and this is what they've done. Our instinct may be, hey, this NEE is doing us no favors, let's cut it loose. Why are we cutting it loose? It's still qualified according to every other metric that we established as our priorities when we purchased it. The only thing that's happened is that price has come down. So, interestingly, what does this do to yield? What does this do to yield? When we bought this thing was paying a 57-cent dividend. It then increased the dividend to 62 cents, and it's held at 62 cents. The yield has gone up on this one. What's happened with our, I haven't looked, just so you know, but if share price is going up and up and up on our other stock, the yield may be coming down, or the dividend yield on an annualized basis may be coming down, unless a company raises that dividend. That's not uncommon with the kinds of companies that we've been purchasing. But the bottom line here is it's easy to develop a strong affinity for a specific stock, and maybe even be tempted to add to it when it's performing well, thereby kind of expanding this bubble of risk that's developing all on its own. And that leads us to a behavior that is actually quite the opposite of buy low and sell high. If I were to say, well, NextEra Energy is not doing so well, so let's cut it loose from our portfolio. Well, that means that I just bought high and I sold low. And if I then add that to the target position, I sold low so that I could then buy high again. That is the opposite of this buy low, sell high. If that's what we subscribe to, if that's what we're trying to do, this is not how to do it. Instead, we're going to go back to target, and we're going to be taking some profits and reallocating that. So what is that accomplishing for us? Let me bear with me for just a moment. I'm cheating. Yeah, I'm looking at my notes because I like to be thorough in these presentations. I have the big, huge, long list of notes of things that I always want to cover during a webcast. But in any case, what's happening with Target right now is that the volatility of our portfolio is now more and more dependent on what Target does. This stock has gone up. If a stock has gone up, in this case, it's gone up from 108 to 150. That's basically a 50%. It was up, I think we're up about 44% for the year. If something can go up that rapidly, what else can it do? We've seen it before. It can fall down maybe even faster. There's a kind of a funny phrase that we use in investing circles, and that is that stocks tend to climb stairs and then jump out windows. And you've probably seen that in practice. Yeah, the downside volatility tends to be greater. And so this stock, which is now 40% larger in our portfolio than an average stock, 68% larger than our smallest stock, is representing a larger and larger position. It's determining the fate of our portfolio in a disproportionate way. That's why we call this risk creep. And it happens in that sort of subtle way. It happens by doing well. So we are going to be trimming this back. So the risks of not rebalancing. Number one, we get increased portfolio volatility. Number two, we get a concentration of our income sources. We now have 7% of our portfolio that derives its income from one stock. And this is after only 8 months. Imagine if we just let this go for years. After years, we may wind up with a relative handful of stocks, maybe 4, maybe 5, maybe 6, that represent a big chunk of our portfolio. And our income, maybe our investor who would prefer not to have concentrated sources of income, now has very concentrated sources of income. Now, I missed something. George, you used a phrase. This is interesting. It is contradictory to everything that I'm talking about. So George has recruited this phrase. He says diversification can create mediocre returns. Water the flowers and pluck the weeds. Okay. It's a different approach to investing, right, George? I'm not going to say there's right or wrong here. It's just a different view of how to manage a portfolio. For our investor who prefers to smooth things out as much as possible, never a guarantee, maybe diversification may assist with that effort. What's the trade-off, though? Well, if an investor is very good at picking stocks, maybe concentration might be the way to go. Because if let's say we just, instead of buying 20 stocks with our $200,000 portfolio, we buy one stock. And if that stock then doubles in value over the next year, that was the best choice or a superior choice to diversification. But I think my exaggerated example sort of illustrates it. Hopefully it causes the right thoughts to bubble to top of mind. Oh, that sounds risky. Putting all your money in one stock? Okay, well then what about two? Well, that sounds a little bit less risky. But that has now doubled the likelihood that we're wrong about the stocks that we pick, right? It's also moving more toward diversification. So I've definitely heard the phrase, water the roses and trim the weeds, which literally, typically interpreted as, hey, if the stock's doing well, add to that one and cut out the ones that are underperforming. Well, that by definition is leading more toward a concentration and further away from diversification. And just because a stock has done well, does that mean that it's guaranteed to do well in the future? No. But it's always up to the individual investor how they want to approach this. If the investor thinks that they're very good at picking stocks, maybe less concentration or more concentration in individual securities is the way to go. Anyway, but I'm not here to say that one way is superior to the other, or that one investor needs to do it one way or the other, but we do need to weigh the pros and the cons. So the risks of not rebalancing are increased portfolio volatility potentially, concentrated income sources, and a potential psychological dependency on one or two or three stocks. And having a psychological dependency on one or two or three stocks, those are the ones, if we have, let's say we have this pattern continues, and ultimately we wind up with Target being 20% of our portfolio and NEE being 2% of our portfolio. Well, guess which one we're paying attention to and losing sleep over every night? What's happening with Target? What's it going to do to my portfolio? Yeah, that can increase what we call, have you ever heard the turnover rate? It's a joke. Turnover rate is how many times you turn over in bed at night thinking about this outsized position in your portfolio. There you go. Those are the risks of not rebalancing, but there are risks to rebalancing as well. George has raised a fair point. Let's give it fair treatment. If we do sell Target and we put that money in NEE and a couple of other stocks, is it possible that Target just continues its current trajectory and we'll leave that, we miss out on some of that upside potential? Yes. Yep. That's a risk. Also, this sort of rebalancing effort requires some scheduling. It requires some monitoring of the portfolio. There's some effort. Yeah. There are other things, you're going to want to ask me about taxes and stuff. I can't talk about tax implications for investing, but they do exist. So keep that in mind. Anyway, but let's figure out, let's rebalance our Target position into, we're going to prop up NEE and a couple of other stocks. So here's the calculation for rebalancing. So we have, let's go check on it one more time. Let's go to our portfolio. Okay, it's at 22,200. And Target's supposed to be 5% of our portfolio. So what is 5% of the new portfolio? That's 22,200. So 5% of that is going to be, what, about 11,100? Should be around there. All right, let's get out our calculator. I'll show you that. 222,000. I keep saying 22,000. 222,200. This is just the growth on top of our $200,000 original portfolio. Let's multiply that by 0.05, and it is $11,110. I'm going to round that off to 11,100. That's 5% of our existing portfolio. Our target position, let's do some quick math on where it sits right now. Have 100 shares at $154.54. Let's call it $154,500. Not 154,000. Let's just round it off to 500. 15,500. So Target is at 15,500. So if it's supposed to be 11,100, we need to sell 4,400 bucks. Okay. We need to sell 4,400. That would bring this down from its current position down right close to the 11,100, which is where it's supposed to be. That's going to free up some cash, and this is going to be the the application of the concept of selling high. Now, could it be that 6 months from now, we might be able to sell higher? It's possible. We don't know that. But let's reallocate that. So NEE, we already calculated. I'm not going to rerun that calculation. But NEE, we have $9,200 in that. We're looking more to be at 11,100. That's almost 2,000 bucks. So we need to buy $1,900 of NEE. So that's going to leave us with about another 2,500 bucks. And what we're going to do with that is spread that out to a couple of other smallest stocks in our portfolio. So I'm going to look at our profit or loss percentage, and so let's just see which ones are the lowest. Okay, next smallest is going to be our TXN. It's actually a relatively new trade, but we only put 10,000 bucks into that, and that $10,000 has shrunk already. So we bought 35 shares. Those shares are worth $277.81. Let's see. 35 shares times 277.81 means that we have about 9,700 bucks in TXN, and we'd prefer for that to be closer to 11,100. So we need to buy about $1,400 of TXN. All right, so that means that we will have invested about 3,300 of our 4,400. Let's just put that final balance in our third smallest stock. Let's see which one's performing the third worst. We only have, don't we have another one that was underwater? It must have reversed course a little bit today. We only have two that are underwater. This one looks like Nike. We're only up a shade, so it's probably right close to still around $10,000. Let's just put our remaining 1,100 bucks into that. Was it 1,100 that we had left over? Yes, that's right. So with NKE, there we go. So let's put this into practice. Let's get trading. And by the way, when I say trading, I just mean getting into or getting out of and then into some investments here. But how many shares can we sell of Target to raise the $4,400? That's at 154.48. Let's get our calculator. $4,400 divided by 154.48. 28 shares. Let's sell 28 shares. Right click. Let's create a closing order to sell. Not all 100 shares. We're going to sell 28 shares of Target. And let's try to get, I'm going to use a limit order. I'm just going to put that in at 154. Just saying we're not willing to sell for less than 154. Are we on, how do we get to XOM? Anyway, this isn't, well, that's okay. Yep. Anyway, we're going to sell the 28 shares of Target for at least 154. Otherwise, the order won't fill. Let's click confirm and send. Selling the 28 shares of Target at 154. No commission on this trade, but that will sell around that 4,400 bucks that we're shooting for. And let's send that order off. And we should, there we go. Yep, 154.47. That's going to be right on the 4,400 bucks. And now we just need to reallocate that. Now I'm going to go make some purchases here. I'll do the calculations after the webcast is over, but we're ultimately going to wind up investing $1,900 more into NEE, bringing that up to around 11,000, 1,400 into TXN, and 1,100 into Nike. But guys, we've accomplished what I set out to do today. I wanted to talk through this process of putting into practice the old advice of buy low and sell high, and how counterintuitive that can feel. And as a matter of fact, I got some good pushback, good healthy pushback on that. For some, it just doesn't feel right, and it may not be their approach to managing their portfolio. That's fabulous. My webcasts are never about trying to advise someone on how to manage one's portfolio. It should be done according to one's own preferences for portfolio management. But in this webcast, diversification is an emphasis, and so we're rebalancing to keep those positions from growing to be outsized risks in that dividend portfolio. All right, everybody. Eva, that class went by so fast. I know it always does, but I'm going to let you go. As I do, I do want to remind you of the resources that are available to you from Schwab Education, starting with our YouTube channel. If you're new to these webcasts, welcome. It's great to have you. Make sure that you subscribe to our channel. You can do that by going right down below the video stream right now. You just click on, or if you're watching on the archive, just the video. Go down, click on the subscribe button. It only takes a second. It doesn't cost anything to do that. But our YouTube channel is where you can join our live streams. You can find playlists of previous webcasts. You can even do keyword searches through our archives of previous webcasts to find topics of specific interest. But let me just show you the playlist for this webcast series. Again, it's called Investing in Dividend Stocks. And so you just come to the playlist page, scroll down a little bit, look for Investing in Dividend Stocks. It's right there on that second row, and click on View Full Playlist. And that'll show you last week's discussion, which was the Dividend Investors Sleep Well Test. We talked through a list of example priorities for an investor that may assist them in reducing, again, the volatility of their portfolio, and hopefully, getting better sleep, worrying less about their dividend portfolio. Now, we also want to give you an invitation to follow us on social media. You can find your favorite Schwab presenters on social media. Brent and I, you can follow us on X or on LinkedIn. Brent, you can find on X at Brent Morris CS. You can find and follow me on X at Cameron May CS. So here's my X profile. There's my handle. And I post on here very frequently. You can see 6,700 posts to date. And if you reply to my posts, I just try to reply right back to you. That's where you communicate with me when the camera's not on. Or you can pop over to LinkedIn and do it there. So you go to linkedin.com/in/Cameron May CS. There's my profile. Leave a comment, and I just reply to those comments. All right. Everybody, thanks for all the thumbs up. Definitely always appreciate that. 113 people watching the live stream right now. And it looks like 42 have already given a like on YouTube. That always helps. So please make it a habit. If you enjoy one of our webcasts, click the like button on YouTube. It's a pat on the back to your presenter, but it also sends a signal to the YouTube algorithm that this was good stuff. Show it to other people. It gives me a nice boost for my video in the YouTube algorithm. Brent, thanks for helping out in chat. We didn't see a survey today, I don't believe. Nope, but if you do see a survey, if you take the time to fill that out, that's fabulous. But guys, I will see you again next Thursday for another discussion of investing in dividend stocks. I also have something new every day of the week, as long as the markets are open, as long as I'm not on vacation. I have a new webcast on a range of topics every day of the week. So watch for those. I'll look for you in those webcasts. I'll look for you on social media. Whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.